How's it going, everyone? It's Leo here. So you see this building back here? I'm actually going to touch basis on that in another video. Just keep that in mind. So for this video, basically what I'm going to talk about is my rental property that I have in Michigan, in Utica actually. So this property is the one that I bought, well, technically last year, December, and I've been renting out for the past like 6 months. And I'm going to go into like an in-depth analysis of all the numbers and everything just to show you and show basically what a rental property should look like and how you should break it down. Again, before I go into this video, I just want to mention that for the first 100 subscribers, and only for the first 100, I'm going to drop my phone number down in the description so you could call me or text me, whatever, if you have any questions or you just want to discuss real estate or just anything like that. So, it just hit me. I work for FCA and we have a massive headquarters over in Michigan. And I'll tell you, since I'm a full-time employee, I have full access to the building whenever I want, like even after hours, weekends. It's a Sunday right now. So I have like this whole conference room just to myself and a pretty decent view, one would say. So I could just like set up right here and just knock out some work there, do my videos, do some work for FCA. So I'll probably be doing some videos here, if not using like this board. So just throwing that out there possibly for future videos. I was thinking about showing you guys a picture of the property, but it's really just a condo over in Utica, Michigan. So there's not really much to see just from like the outside, the inside. So I think it'll be more beneficial to just go over the numbers and, not disclose, I guess, any confidential information or like if by any chance someone goes and like bothers the tenant. So I'll just keep it like this and then show the property with the numbers and financials here. So this is my calculator right here. You can see the rental property calculator, and I have it where you can see the 15-year mortgage or the 30-year mortgage. Now, since I went in on it with a 30-year mortgage, those are the numbers that I filled out. And then I'll basically break it down. You can see the center column will be keynotes where I could see the value, which is basically $72,500. I put 10% down, 5.5% interest was what they gave me. Keep in mind, this was my first property, so I was just trying to get anything. I wasn't really being too picky, and they took a chance on me since it was my first time. I was 20 years old. So I know that interest isn't the best, but also to take into account, it was a conventional second home loan where you could see on the loan and classification. Now, second home loans are basically vacation homes, so you get a bit more interest because of that since it's not a primary home. And then I bought it in Utica, Michigan, and my closing costs were around $5,000. So overall, what I put into the deal was about $12,500. So all these numbers you're going to look at here are going to be annual. So you got the income and then your expenses tabs. So I'll basically add them up towards the end, and then you could see from there. So then for rent, I'm getting $10,800 a year in rent. So I'm charging $900 a month times 12. Now for principal, I'm being charged $4,446. All of these are rounded numbers just to not have any cents that are getting in the way. So again, annually. Now here for equity, you can see I'm getting $845. So something I noticed is I made this formula 0.19, so 19% of this number here, because I remember that if I look at my monthly statement, I'm paying around $367. Well, actually, you know what? Let's do the number here. You got 4,446, and let's divide that by 12. That's how much I'm paying monthly in principal. And then I know that I'm getting around $70 in equity, so I just divided that by the principal I'm paying, and then I got 0.19, so 19%. So then I added that in here, and that's how I'm getting the equity. So that's an income I'm getting additionally, basically just my rent and then equity being added on by my payments to principal. So then you got the association fees here. I put if needed because let's say if you have a single family home, you're not going to have an association, or at least there's a high likelihood that you won't. But since it's a condo, I do. It's $200 a month, so $2,400 a year. Came in with taxes and insurance. They were compiled into escrow for $2,006 for both annually, so I just split it up evenly there. Probably slight differences, but you could just see it added in here. So these are just, factors to take into account. Now, utilities, since it's rented out, my tenant's paying it, so I got nothing there. So now for these yellow tabs, I'm going to touch in a little bit on these because you got vacancy, repairs, and capital repairs. Now for capital repairs, since it's a condo, I don't have to worry about, let's say, like a roof or any like major expenses other than maybe like, I don't know, let's say like my water heater or stuff like that. Since it's a condo, association should help out with the bigger expenses. So I just put this in half. So most people that are like real estate investors would charge around 5% just to keep that like as a safe reserve in case anything ever happens. I put 2.5%. So that seems pretty conservative there. So I'll keep that. But then for vacancy and repairs, I use 5%. These, I guess, they're nice to have more as like a backup. That's why people always recommended them. Personally, I haven't had to worry about either of these so far, but I'm still going to take them into account. And then you got that 540 annually, and then 270 annually. Now, property management, I manage the property myself, so I don't have it. But let's say if I were to have a property manager, it would be 10% of my rent, so which is $900. So I'd be paying $90 a month for property management. So now here, if you look at my total income and expenses, I got them in yellow. So the yellow signifies that I'm calculating with the if needed values, these three here. So my income comes out at $11,645. I got $10,203 in expenses. So you take the difference. That's how much profit I'm making. And again, this is worst case scenario. So this is assuming like I actually end up using all of these here, both vacancy repairs and capital repairs, which so far I haven't, but I'm taking it into account. So my total income will be $1,442 annually. Cash flow will be $597. So liquid cash I'll be getting. So here, I basically just subtracted from my equity, which is, just equity in the house. So you can't really see it until you end up selling the house or maybe when it's paid off. So it's money, but I guess it's not liquid money at the moment. So if you want to take that into account, you got cash flow. Now for my cash on cash return, this is what I did. Since I spent $12,500 acquiring the property of hard cash, and I'm making, I-21. Let me see what that one was. So yeah. So I'm taking this one here into account and then just dividing that by the 12,500. I'm making about 5% on my cash money every single year. But taking into account equity, I'm actually making 11.5% return just on this property, taking into account equity and cash flow. Now, people say that the stock market gives you 7% annually, so hell, this is just more proof that real estate does you well. And this is taking into account the worst case scenario, or at least like what people always say to take into account for, even though it doesn't always happen. And then from here, we got the total income and expenses with the best case scenario. So not taking into account the yellow factors. So same number for income, less expenses then. So then my total comes out to $2,792, counting equity and cash. My cash flow will be $1,947. So my cash on cash return is 15.6%. Since exactly, I'm getting, $1,947 a year annually in cash, and then $12,500 is what I invested. So I don't know, probably like 7 years cash on cash return, I'll make my money back. But now taking into account equity, it'll take me less than 5 years to make my money back. And then from then on, it's just profit. So these are some really good numbers when it comes to my return. But now if we average it out, you could see here I got my average cash on cash, where basically I just took the 15.6 and the 4.8, added them together, and then just divided by 2 to get like an average. So this is what you're looking at for this property that I have. I'm making about 10.5% cash on cash and 16.9 total return. And again, I haven't actually had to pay anything for vacancy repairs, cap repairs, but I still got probably half a year left, so maybe some expenses might come out. Just knocked on wood, so hopefully not, but it could happen, so I'm taking all these into account. So the reason I went with a second home property was because at the time, again, I was young, I was 20, who really wanted to lend to me? So I couldn't get a primary home because I was in Miami and I bought this property in Michigan. But an investment property would have been like 25% down, and I didn't have that kind of money at the time. I had around $16,000, so that would have been too much. So I basically just looked into a second home property, which I recommend people take a look at too, but there are some restrictions on it. Like this second home property I can't buy a primary home or a secondary home within 50 miles of that property. So if you buy, let's say in Miami, a secondary home, that's it. That's your secondary home. You can't buy anything within 50 miles of there, unless it's an investment. They don't really care about investment properties. So that's why I went ahead and did this loan, just because it was the most convenient for me to be able to get into real estate at the time. And it did come with some benefits, because at least I'm here, I'm getting the experience, I'm getting money as well. So I'm extremely grateful I was able to do that, and that was thanks to Quicken Loans. I'm actually currently in the process of getting a new loan. I'm still deciding which lender I'm going to go with and everything, but I'll see. I'm looking at Quicken Loans, guaranteed rate, and maybe just some local lenders here, but those are the ones I'm looking at. So this rental property calculator that you have here, it's adjustable. These have some assumptions like, 10%, 5.5 interest, but I actually don't have, I was looking at, he's actually my inspiration for doing this, so I'm pretty sure you might know Brandon Turner. But I had a mortgagecalculator.org. I use them a lot to do this beforehand. Now that I know how to run the numbers myself, I use my own Excel doc. But before then, go to mortgagecalculator.org if you want to break it down a bit more in depth, because I'll show you the 15-year, 30-year. I'll go to mortgagecalculator.org and then implement those numbers here and then add on any factors I would want. So, yep, this is my breakdown. I'll be doing more of these regularly. If you guys want, I'll just open up a property near here for sale, and then I'll just run these numbers down. I'm trying to make this on a regular basis just to help everyone out. So yeah, thank you for watching, and if you've enjoyed it, please like, comment, and if you're not already, please subscribe. That helps me out so much, you can't even imagine. And thank you. Have a good day.